Good evening and welcome to this weekly edition of Money Control Markets Weekly. It's been a good week for the Lal Street, especially the benchmark indices, which closed the week on a strong footing. You had both Sensex as well as Nifty gaining 1.5% and over each. We'll talk a lot about markets, the key emerging themes that one needs to keep an eye out for. Please join me in welcoming Mr. Viraj Mehta of Equirus. Thank you so much, Viraj, for taking time out and for joining us on this very eventful week for the Lal Street.
Thank you so much. It's a pleasure to be talking about markets with you.
What I'd like to understand is, firstly, your view on the markets. Do you believe we have enough triggers to breach that 17K, 18K mark? Because 15,000 was a huge resistance for the benchmark index, as we all know it. And now 16,000 has also successfully been breached by the Nifty. What are some triggers that could perhaps push the market, push the benchmark index higher?
So if you look at the historical valuations and how some of these Nifty as an index has traded, if you look at the valuation and steep correction in valuation of Nifty index over last 6 months due to spectacular earnings of some of the companies, especially some of the steel companies in the index, especially some of the large corporate banks, have improved the earnings of these index so dramatically that the Nifty is kind of just slightly above its average valuation and not by a lot. So if I think we continue to see the kind of earnings that are expected to see over next couple of quarters, and we do not really see a third wave, and those are the few things domestically that we need to be okay with. And of course, there is no global paper tantrum or US Fed decides something else. If those 2-3 things just co-align, then not only 17,000, I think we have a lot more to scale up from here as well, because the earnings trajectory and the kind of optimism that we see in India Inc. is absolutely unparalleled. We think that some of the sectors and some of the tailwinds that some of the companies, larger companies, are seeing are absolutely fantastic. So I think index is an relative outcome of all the stock prices of large companies in India, and put together the kind of optimism that we are seeing. We have no doubt that these numbers will be breached sooner or later.
Absolutely. You just mentioned earnings. What was your key takeaway or your key highlight from Q1 performance? Most sectors did not disappoint us, is what we understand. But if you could share your thoughts on which sectors outperformed your expectations.
So overall, put together market.
And allow me to interrupt you here. And also the sectors which will continue that upward trajectory, more importantly.
Sure. So I think fair question. I think on an average the markets did okay, considering that a bulk or a large part of the lockdown that was there, strict lockdown which was there due to wave 2, was in this Q1 of this calendar year. But I think most of the companies in India have worked out a way around this, to keep the production going, to keep the supply chain going, for most of the people to work from home, and primarily causing no disruption to their manufacturing. Some of the key sectors that we thought did really well, I think IT did fantastic in terms of the expectations and what they delivered. I think metals, even though the expectations from metals and some of the consumables were very high, they kind of delivered on those high expectations. I think large corporate sector banks did pretty well. I think some of the smaller sectors as well, which are not usually on the radar, but something in capital goods, in housing finance, in real estate pack, cement. These are some of the smaller sectors that also did well. Not to mention the kind of the upside that we are seeing in textiles that also seems to be doing reasonably okay. So these are the sectors which are doing well. The only sectors which I thought disappointed a little um, were particularly unsecured lending, so microfinance, personal finance, all of MSME lending. Some of these financial institutions kind of disappointed. Apart from that, some chemical companies where they had, and some of the pharma companies which had high expectations out of them, but the raw material prices just went through the roof where they couldn't pass on. Uh, had a slightly tepid quarter, but on an average, I still think it was a fairly good quarter. And the commentary that we are seeing across industry, it seems the good run is set to continue.
Well, I'm sure a lot of our viewers and retail investors, more importantly, are must be quite excited hearing your bullish commentary. But let's talk about some important cues as well to watch out for. Everybody is watching the US Fed's Jackson Hole meeting. There are talks of tapering as well that are doing the rounds. Global markets seem a bit jittery, a bit unsure perhaps. And at such a time, what should investors do, especially the ones back home? Should they stay put? Should they keep a watch on how things play out? Or should they book profits and look at a better time to re enter?
So I think I mean, the answer is in the history, right? I mean, you look at last 10 years, since 2013, last 8 years, whenever Fed has talked about tapering, market falls, corrects a little, so Fed kind of normalizes their comments a little, then market goes up, right? We have, except probably the fall that we had in 2020, and which had nothing to do with money printing and how dovish or hawkish the central banks were. We generally had no real impact of how US Fed or most of the other central banks have impacted as well. One more thing I would like everybody to think about is, if you look at the dry powder that globally people are sitting with, US private equity funds are sitting at the highest dry powder that they have over last 12 years. US mutual funds are sitting at record liquidity. Today, we have more than $6 trillion of debt funds which are yielding negative return. So, my view is, even if we would probably have a 0.5% correction in the benchmark rates, or a percent correction in benchmark rates over a year, and you would see probably securities, be it stocks and bonds, both correct in a slightly shorter period of time, let's say next 1 month. But there is no way that you will have such large amounts of dry powder which is there looking for yield, which will not come looking for yields, including the earning assets in India as well. So I would think there are enough opportunities, and to look more bottom up rather than try and take a top down view of such situations.
So, any opportunities that you'd like to flag off for our viewers?
A lot, yeah. I think if you were to actually look at valuation, except some of the sectors which are very richly valued, where the expectations are sky high, like some of the select, I would say, platform companies or some of the chemical companies, where the valuations are absolutely sky high. A lot of the companies where expectations are not sky high, valuations are at a I would say a 10-year average, is where a lot of opportunity exists, right? And there are multiple sectors in these. Like, you can look at capital goods, large corporate sector banks, cement, housing finance companies, real estate players, some of the EPC players. IT on an average, I think, should do okay. Some select pharma guys should do okay. Uh, so yeah, as I said, tourism should do fantastic. I think I think one behavioral pattern that we are seeing a lot of, I would say, half a generation kind of following, is the kind of the YOLO in everybody has come out, right? So whenever things normalize, you would see people buying lot more cars, or buying lot more houses. People are ready to spend behind houses. People are ready to spend on experiences, on tourism. I think these are material changes which have impacted the psyche of the people, which I do not think will change very near term.
You mentioned tourism. Which segment within tourism do you like? Is it someone like Ease My Trip? Do you like aviation? Do you like hospitality? I mean, what kind of sub-segment should one focus on at this juncture?
Actually, rather than looking at each of the sub-segments, we should look at what are the capital intensive industries and what are the capital light industries. We kind of like the capital light industries, be it Ease My Trip, what you said, or some of the casino companies that we own, um, uh, or, or some of the hotel players which do not have their own hotels, but they rent out the hotels from someone else, right? So we like more asset light players rather than asset heavy players. And within that, you have to focus on who has the right to win, who has the market leadership, and who has the who has the right to win in the industry. And if you actually kind of then bifurcate, you will not be left with more than two, three, or four names there. So those are then pretty easy to kind of pick and just invest in them for 3 4 year view.
Okay, valid point. Let's come right back and talk about more mainstream and more conventional sectors. I'd like you to draw your attention to what's happening in Nifty Bank. Because despite the benchmark Nifty 50 index hitting an all-time high, and the overall banking sector, if you look at it, is relatively underperforming. In my discussion, which I had with other investment bankers, portfolio managers, they mentioned that public sector banks can be avoided from one's portfolio at this juncture, while names like ICICI, Axis Bank keep coming up in, when it comes to stocks to bet on. Where do you stand when it comes to banking space?
So let us look at a history, right? I mean, bank Nifty has done worse off than Nifty only over last year and a half. If you actually look at 5 years before that, Bank Nifty has outperformed Nifty every single year on a rolling basis of 3 years, right? So before Corona, you at one point had financial institutions more than 40% of the Nifty as an index. So these guys had like really great run for almost a decade. And last 1.5 years, they've kind of underperformed the Nifty because of obvious reasons, because they are going to be the most stressed because of collections and NPAs that they are facing, and the recurrence of that in the second wave. So I think it is a right underperformance that they have kind of shown. But coming to what should we look at, I think some of the names that you mentioned, be it ICICI or Axis or HDFC Bank, some of these are bellwethers who have gained market share across time frames. And they're actually getting their act right, both in terms of cleaning up their balance sheet, and the right to win the market leadership going forward as well, because of the low cost of deposits that they have. Uh, I have no doubt that some of these guys today probably are at 2 3% market share, will be high single digit market shares 5 years out. And I wouldn't actually touch public sector banks at all. If ever we were to buy some private sector lenders, today we own none. But if we ever were to buy some of these, the only place to look at is some of the corporate sector, private sector banks, which is where I think large delta will be created over next 2 years. Also, some of these have large other business portfolios, like ICICI has brilliant insurance businesses that they own a part of, and a brilliant mutual fund business, which also probably will get listed over next year or so. Some of the value unlocking that you will see happening in these businesses will also make the core lending business to be significantly cheaper than what it looks optically today.
Hmm. Hmm. Right. But within the larger, basket of financials, you've made it clear that you don't like lenders right now. But what is your sense on insurance? You also mentioned HFCs earlier on in the conversation, or even NBFCs. Do you like any of these spaces right now?
So we think HFCs is poised. We think real estate in general has gone through a 10-year downturn. We see large, I would say, growth opportunity in this and sector consolidation that's happening in real estate. There are only a couple of ways you can play this, right? Either you can buy direct real estate players, or you can either buy HFCs, as in ancillaries. Either you can buy HFCs or tiles or pipes or wires or some of these kind of providers, ancillary providers. Ancillary looks way better to us today because of the competitive positioning that some of these guys have. HFCs is clear beneficiary of some of the housing boom that we will see going forward as well. Um, so that is in terms of NBFCs. I think NBFC's right to win across the segment is very low. Only in probably housing finance and to some extent in gold finance they have significant right to win vis-a-vis their competitors. Except these, we are not really big fan of NBFCs. We think larger corporate banks who have cost of capital advantage will tend to garner market share across almost all other spaces.
Okay, all right. So, in your view, the best way to play the boom or the recovery in real estate space would be pure play builders and developers, or proxy plays like HFCs, cement, construction, home improvement are a better bet.
Yes. So in actually in builders, right? You don't have too many choices with people whose balance sheets are kind of clean, right?
Yeah.
You have DLF, which has significantly pruned down the debt, but very few players of scale and size, and some of the larger players like a conglomerate in India has India's one of the largest real estate players, but those are like really eye-watering expensive. Like those traded like 10 and 12 times book. We are not kind of a big fan of paying up so much. There are some of the niche smaller players based in Bangalore or Pune or Bombay specific. You can play through one of these because they're also debt free and reasonably cheap, or you can play through some of these ancillaries. What I would advise is think of this play as a basket. Pick winners, as in pick leaders, two or three in each of these, and put total cumulative, I would say 10-15% in all of these put together. Some of them may still not do well, but as a basket they'll do very well over next 3 years is what our belief is. As a layman, it'll be
Okay.
difficult to kind of separate the wheat from the chaff at this point.
Okay. Let's shift gears then and talk about some more themes that are in the limelight, and one cannot ignore what's happening in the metal space. Whether it's good or bad, for one or the other reason, metals week after week is very much at the center of all the attention. So, if we talk about metals, there is a lot of news flow around it. Every week, there's some news which affects the stock prices of metal related companies. We get a lot of queries about stocks like Tata Steel, JSW Steel, or even smaller companies like a Godavari Power, Graphite, HEG, etc. What would you advise investors to do at the current juncture? When it comes to metals, have the valuations already run up and one should not look at buying at the current levels and wait for things to cool off, or is it still a good time to play the theme?
So generally, our core belief in commodities is a single line thing. You buy them when they're losing money. They were losing
Hmm.
money a year back, which was the best time to buy them, right? And but you do not know how long the wait is going to be. You do not know whether it's going to come good next year or the year after or the year after. If you try and board a train in the middle, right, there is always a danger that will be knocked off, and this is exactly where um, uh, this is exactly where it gets tricky, right? Because if you buy today, you're going to be certain that the cycle is going to go well for next couple of years. Because even if the cycle is going to go good only for next 6 months, the stocks will correct way before even the end product price is correct. Our belief is that end product prices may still do okay for a year or so, but buying some of these metal names which have run up so much, which trade at a significant premium to its 10-year averages, is not an easy choice. It's something that we wouldn't do and we would like to avoid.
Okay, so you don't like any of the name, whether it's blue chip companies or whether it's these smaller players like a Godavari, HEG, etc.
So okay, so Actually, within so HEG, be
or
it
even if it's non-ferrous commodities play like a Hindalco, perhaps. I mean,
no, so non-ferrous is so historically, if you look at the I would say the cycles for non-ferrous, be it aluminum or copper, tend to be far more I would say elongated than ferrous. They tend to be
hmm,
3, 4, 5 years compared to or 5, 7 years compared to steel, which could be anywhere between 2 years to 3 years. So the
yeah.
stock prices also of the non-ferrous tend to be far more, I would say, easier place to be in. We certainly think there is a lot of value in non-ferrous for sure, not steel, but non-ferrous, be it consumable, right? So if you look at consumable of non-ferrous, you have refractory plays, you have plays like you have direct plays like Hindalco. You also have some of the largest CPC manufacturers globally are housed in India, which is used in aluminium, something like Rain Industries. And the disclosure here is that we own Rain Industries in our fund. We think some of these companies have a longer cycle to play,
Hmm.
and have a longer horizon, rather than steel, which we think is already somewhere in the middle, and it's a far more difficult play to time at this point.
Okay, fair point. So let's just talk about some more sectors, especially from, the smaller mid and small cap space. Sugar is definitely very much on the watch list, whether it's traders or investor community. It has seen a lot of news flow, especially around ethanol of late. Certain stocks have seen their prices zoom ahead in the past few months, followed by a bit of consolidation. Of course, we saw an overall consolidation come by in the broader markets, and sugar stocks also sort of did witness some amount of profit taking there. Is this a right time to enter sugar stocks given the news flow and given the triggers in place, or would you stay away?
So, I think brilliant question. I think sugar in general will be far less cyclical in the future than what it has been in the past. Some sort of re-rating in some of these sugar stocks has already come in, be it some of the market leaders like Balrampur or Dhampur, or some of the bankrupt plays like Sri Renuka, which was taken over by Wilmer post that. Um,
Hmm.
I think there are multiple ways to skin the cat here. Either you can play it directly through some of these guys, and that also is an okay way to think. But there are capital goods player who supply for ethanol, right? Um, you have 2 or 3 large capital goods players like a Praj or an Isjek, which supply machinery to these players. Now, whether government changes the rules of ethanol play 3 or 4 years out, we don't know, which is a risk for some of these guys who are putting up a plant today. But the guy who's supplying the plant has no risk. He's going to make money irrespective of whether the end player is going to make money or not. So you can look at some of the market leaders, and I would look at only the larger couple of plays here, rather than try to be cute and try and look at a bankrupt company. I would look at some couple of the larger players here, or look at the
Hmm.
two ancillary manufacturers who's supplying them boilers and everything for next couple of years. They'll have tremendous growth trajectory in earnings. Yeah? So both the ways look okay and good to us.
Okay, well, that's good to know. Since we're talking about stocks from the mid and small cap space, last couple of weeks have seen a severe correction of sorts when it comes to the broader end of the markets. It's shaken retail investors because most of us did not see it coming. Part of it was, of course, because of the BSE circular. We've got many queries on what people should do. How should they devise their investment strategy now, given the fresh correction that they've seen in the market? Well, a lot of them entered in the past few months, and they've not seen such a downtick ever, perhaps, especially for the ones who are first time traders and first time investors. What do you advise to this particular retail community who has just started out in the markets and perhaps a couple of months into it have witnessed these massive downturns?
So sorry to for correcting you. I don't think this is massive downturn. I mean, as an index, we have dropped like 7%, right? I mean, that's absolutely nothing. If you were to think even a couple of years, it's nothing. The problem is that last 12 months we have only seen stocks going up, 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 up,
Hmm.
and even a 5-10% correction kind of upsets people. uh,
Yeah.
I think it's just part and parcel of the game. I think if you actually know the company and like the company, this is a good time to double down, or probably buy a little bit more, provided that you know your company well, you know the earnings trajectory of your company well, and you know the valuations are right. There is absolutely no harm in buying more, provided you know all the three that I mentioned above. We shouldn't worry about what's going to happen next week or the week after or the month after. If these are solid companies, in a year's time or a year or 2 years time, you will be significantly better off investing in equities and growth stocks, rather than buying almost anything else in the country.
Absolutely. And just one last question, which we ask most of our guests who join us for this conversation. If you were to start out your market journey today and you had, say, a corpus of 5 lakh rupees, how would be your sector allocation or your asset allocation as well? How would you sort of start this journey?
So if I'm starting out, I'm assuming I'm 2025. Anybody who is 2025, 30 should put all their money in equities here. I mean, equities have outperformed debt significantly, and especially when your time horizon is long, right? If you're 25, your time horizon is at least 25, 30 years. That means none of your money should go into debt. Everything should go into equities. Whether you decide to go put it through mutual funds, some of the best guys in India manage some very good mutual funds. Yeah, I wouldn't actually. I would think banking still remains the cream of the pack. When you have to think larger allocation, some of the FMCG looks really expensive. Some of the pharma names look okay. I think some of the old economy stocks look brilliant at this point. You can keep SIPing something like a Larsen looks brilliant. So you can keep SIPing some of the, I would say 30-40% in banks, 10-15% in pharma, 10-20%, 25% in small and mid caps and some of the emerging themes, and the rest of the money should go to probably some part in the mutual fund. But if you are young, I think the biggest mistake is not to put money in equities, all your money in equities.
Or I hope our viewers are taking note of that and agree with your suggestion and your recommendation to them, especially millennials and youngsters who range it between 20 to 30 years of age. They should park their money in equities, is the word coming in from our guest today. Well, thank you so much, Viraj, for joining us and for sharing your thoughts and your observations of different sectors and different themes that are dominating the market at this juncture. It was a pleasure having you on board.
Pleasure. Thank you so much.